Hello, Phoenix. I'm Stewart Willis, and you're watching the Asset Preservation Hour. Today's show is going to be packed with information. We've got tons of stuff to talk about. We're going to start the show off with talking about the importance of diversification and where most people get it wrong. We're also going to talk about real estate. Everyone loves talking about real estate here in Arizona, but does it make sense in your portfolio? We'll talk all about that. And then, of course, tax planning for success. Now, to cover all these subjects, we're joined today by Nathan Faldmo out of our Gilbert, Arizona office, and my good friend over here, Dan Murphy from Peoria and Gilbert now as well. So we've got some Gilbert concentration in the office.
I'm not your good friend, Stuart? What? He's your good friend and I'm not?
Listen, I mean, things have been awkward lately, so
Okay.
I just,
Right,
I'm being honest with my friends in the audience here today. So here we go. No, love you, man. Love you, bro.
Sounds good.
All right. Well, so let's kick this off here with diversification, guys. Look, I think everybody has heard that you don't want to have all your eggs in one basket, and oftentimes what we see when clients come into our office is they'll have 50 or 60 different stocks, mutual funds, etc. But is that really true diversification by just having a bunch of stuff? I'll start with you, Nathan.
It's not true diversification because on the surface it seems like you're spreading everything out by having everything in all your money spread out in different funds. But in the reality, a lot of these funds have the same holdings within each of these funds. A lot of them are using the same algorithms, the same technology. So now we're looking at a portfolio that actually has a lot of the same positions, even though you think you might be diversified. When you dive into the actual positions, you're owning a lot of the same things within those funds.
Right. So Dan, when you see that this sort of overlap he's talking about in the portfolios here, it gives you this false sense that, hey, I'm diversified here. But how do you measure that when you see a client coming in and you're doing a portfolio analysis? How exactly is that measured, and are clients surprised by the result?
Yeah, I think what happens typically is you've got, a correlation where people will have a lot of the exact same sort of holdings in the same overall portfolio. So they'll have a bunch of money that's sitting in stock. They have a bunch of money that's sitting in, large cap growth, some small cap, and they come to you and they're like, hey, I think I'm diversified. But when the market completely falls apart or does well, all of a sudden they realize, are they really diversified when all is said and done,
well,
right?
Because that's the big question here, right? When it comes to diversification and correlation and concentration risk and so forth, I think oftentimes, look, we've all heard about the Magnificent Seven, right?
Sure.
The top 7 stocks that have made up most of the return of the S&P 500, the FANG stocks, Facebook, Amazon, Netflix, Google. Now NVIDIA has, joined the club as well. So I guess it's FANG with 2 N's, right? So,
Right.
All of those positions have really brought forward the market in these very concentrated positions. So if you're not concentrated, Nathan, are you going to really see the full benefit of the market?
You absolutely will not. In fact, we see this all the time in a 401k. Someone will come and say, hey, I'm diversified. I'm in this target date fund, for example. And whenever I look at a target date fund and really dive into the analysis of what these target date funds have, it's almost like you're taking this big net and you're spreading out all throughout the water trying to catch the fish. And so you're investing in everything. And the reality is you're investing in nothing if you're investing in everything. And so you have almost no exposure to the NVIDIAs and some of these which have driven the market. And now you're underperforming, even though you might be taking a risk level that's higher, but you're really not.
So let's focus on target date funds, for example. I know I'm going off script a little bit here, not that we're scripted, but I think it's important to understand what we saw in 2022, right? If somebody is a balanced investor, they had 60% equity, 40% bonds, or they were conservative and had 60% bonds, right? And they held to that standard, right? They got absolutely smoked.
They got killed.
Didn't they, in 2022? The bond funds didn't really kind of hold their own. They didn't protect people like we thought they were. But the target date funds, what was even worse there is that their prospectus says that we will be invested, and they tell you what they're going to be invested in, and they have to keep those ratios. So they're just watching as the world changes around us, and this prospectus says we are going to stay invested in this thing. It doesn't have the same sort of tactical agility that money managers have to shift the strategy, does it?
For sure. I mean, volatility plays a big role in that too, right? I mean, when the markets are doing what they're doing, some of these volatility indexes or ways that people are invested are putting them in a position where when you want to take advantage of the top side of the market when it's taking off, many of these actually kind of pull back and they keep you in more of a cash position because it doesn't want to take the risk due to the volatility, variations that happen. So you got to be careful with that concentration.
Yeah, but it's so easy, like with target date funds, Nathan, to be like, hey, I can pick one fund. I don't have to pick 10 different things. Why, let the professionals do it. But is that really a professional approach, or is that just the lazy approach? We're starting to see target date funds in all the 401ks.
Sure.
They're in thrift savings plans now. My good friend Joe Wilson out of Cincinnati there, he just says you're pushing the easy button, and it's a lazy way out, and it's a good way to get to the bar.
Well, here's what happens. These companies that are providing their employees with these plans, they want to cover themselves, right? It's a liability issue for them. They don't want someone to be too aggressive, and so they're going to encourage employees to take something that's going to be less aggressive in theory. But like you said, we just talked about this. In 2022, bond markets went down more, especially the longer term bonds, they went down more than the stock market. So here you are, a conservative investor, and you're stuck. And it didn't recover. Still hasn't really recovered.
So people who could afford to lose the least lost the most and never saw the rebound when we saw one of the greatest rebounds in market history. So as we talk about diversification, diversification is about making sure your investments do different things, right? Clearly, bonds haven't proven to do what they should be doing, at least what they've done historically as interest rates fell. Because as interest rates rose, bonds just haven't performed, right? And so there's been other fixed, avenues there that, that we can talk about. But to get your correlation coefficient, which is the measurement of correlation, to get those corrected into a proper portfolio, a lot of people are saying, hey, well, let's just go to real estate. Now, here in Arizona, especially where you guys are, in the Gilbert area in Scottsdale, property has just gone through the roof, right, in value. My wife is like, holy mackerel, in Scottsdale, we're now paying California prices for Arizona. We moved here because it was cheap. Right? Now, don't get me wrong. I'm having to deal with this summertime issue here. She can't stand the summers here and wants to, go get a place somewhere where it's cool. But, it's no longer the cheap place anymore. So people have seen this massive growth in real estate values because all the people from California have come over here, and other more expensive places have wanted to come to a low tax state, and we're growing like crazy. But does it make sense to have real estate inside your portfolio? Inside, should you be owning rental homes as a general investment, Nathan?
Yeah, I think it's hard to put a blanket statement. I know you're going to you wanted me to be some one side or the other, but the reality is,
position.
The reality is, it's going to depend on what your situation is, because some people aren't going to have. Well, first off, it depends on where your money is from the umbrella, tax umbrella. If you have a lot of money that's outside of a retirement account, which often people don't, but if you do, you can take advantage of some great tax-efficient strategies to offset taxes from income that you have within the real estate or elsewhere. But if you don't, a lot of people are stuck within an IRA or a 401k or a TSP, and now you don't have those same benefits.
Yeah, see, I'm looking for more action here. No, he's halfway in between. Dan, what do you think about real estate?
The only thing that I've noticed with a lot of clients is it definitely causes some liquidity issues, right? So, you have to know what you're doing. People that are just haphazardly, my grandparents made a bunch of money in real estate, and I'm going to go try to do it. There's a lot of expenses that are involved with that. But the other thing I've noticed too is the liquidity is definitely a problem, but you also have like depreciation. What is it, 27 and a half years of depreciation that you can take, from a...
So to me, if I were to say, hey, what is the common thread amongst our ultra high net worth clients, I would say it's real estate. Right?
100%.
I don't sell real estate. I need to figure out how to make some money on real estate.
Yeah.
I am not a broker. I don't make money. But people are surprised on the television show that I support real estate as much as I do.
Takes money out of your pocket.
Well, darn it. I'm as a man of leisure, I'm trying. No, listen, as a fiduciary, I think it's important that we say what's right for the client, not just what's right for us as a firm.
For sure.
Right? Real estate, I'm not a licensed real estate broker. I don't make a dollar on it. In fact, it does take money out of our firm for people to buy real estate. But the depreciation you talked about offsets that cash flow if it's positive, right? In some of the most efficient tax profiles I've ever seen. These efficient tax profiles, most of them are because of real estate depreciation that offset your income. I think it's an important piece for people to have. And look, when we talk about diversification, if you think that you're over-concentrated, if you have those target date funds inside your thrift savings plan, if you're 59 and a half or older, you have options to get out of those sort of plans. There's ways that you can have your money professionally managed if you're over 59 and a half and you're still at work. You don't have to retire. You don't have to, quit your job to get access to that. If you want to find out if the real estate makes sense for you in your portfolio, or maybe you're sitting on real estate and you're trying to find out, hey, does it make sense? Because maybe your depreciation schedule's over and now it's time to make that hard decision. If you want to get a second opinion to see if it makes sense for you, well, just give us a call. This week, we have only 10 meetings available in each of our offices this week here, but we have offices all over the city here. We have Tempe, Goodyear, where is it? Peoria, Scottsdale. Where the hell are we here?
Gilbert.
Oh my God, I forgot about you guys. Gilbert, we're all over the place.
You need to slow down your growth.
We have an office nearby you. We have 10 meetings available. Give us a call, 833-602-PLAN. We'll sit with you for 90 minutes. We'll go over whatever you want to talk about to look at your diversification, what kind of risks you're taking, what kind of fees you're paying in your portfolio. But you have to take action. Pick up your phone, click on the QR code. That'll take you to assetpreservation.com where you can claim your free review. Don't go anywhere because when we come back, we're going to continue the conversation on real estate. But this time, does real estate make sense inside your 401k or your IRA? We'll dive deep into that. Don't go anywhere.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. Plan your retirement right. Call right now for your own complimentary portfolio review and tax analysis.
Do you know how much risk you're actually taking in your portfolio? Oftentimes we see investors taking way more than they're comfortable with. And if that describes you, you should get a second opinion from a fiduciary advisor at Asset Preservation Wealth and Tax. We'll take a look at whether your portfolio might actually be able to survive another financial crisis or market correction. So claim your free portfolio risk review, click the QR code, call the number on your screen, meet with a wealth advisor at any of our convenient locations around Phoenix.
Welcome back, Phoenix. I'm Stewart Willis, and you're watching the Asset Preservation Hour. Now we're going to continue the conversation on self-directed IRAs. Now, let me tell you what that means. A lot of people want to do it themselves. They want to invest in things they know. Things like real estate. And they've heard about this big real estate boom that's been going on in Arizona, and they want to know, does it make sense to put this real estate inside my IRAs? Because oftentimes that's their first seed money to buy an investment property. Nathan, what are your thoughts on self-directed IRAs with real estate inside of them?
Well, the first thing that I want to understand is what's the role that the real estate's going to have within your portfolio? Because to your point, we've had this huge boom, especially in Arizona, with real estate. And so a lot of people, could be parents, grandparents, whoever it is, have made all this money. Or maybe you've made a lot of money in real estate, but does that mean you're actually going to continue to make money in real estate? I don't know. I've had clients that have owned real estate for a while now, and they feel like they keep putting money into it and not getting as much out of it. And the rate of return, what are you getting out of it, isn't necessarily matching what the stock market's doing.
Well, I think the good old days of interest rates falling really fueled this brush fire that we've had in terms of real estate prices going up. But now, listen, Taiwan Semiconductor, Intel, all of these additional, these companies are coming to Arizona as a very favorable place to hire.
Yeah.
And more people want to get out of those high tax states. So, that's keeping the prices solid. We're not seeing a massive price decline here.
Right, yeah.
But I think the days of the 10, 20% a year real estate growth are probably, they've gone the way of the dodo bird. Dan, any other downsides to the IRA, or real estate being in an IRA?
Yeah, I mean, when we talk taxes, because taxes are a huge portion of what we do, right, is it puts us in a position to where you can't really do as much planning. If we're doing Roth conversions, for example, when you've got so much money, I had a client that had literally about $3-4 million that was in real estate, and then we're managing another portion of it. And so much of that money, they wanted to make sure they kind of put through the ringer with regards to a Roth conversion. But you can't really do that when you have money that's tied up in real estate, right? It puts you in a difficult position. So
especially to pay the tax bill, because
100%.
Because I've seen people, if we're talking about downsides,
Yeah.
I'll throw one out there. Required minimum distributions.
Mm-hmm.
If your cash flow doesn't keep up with the required minimum distributions as you get older, you know what their answer is? And by the way, the disclosures on these self-directed IRAs, that's what scares me. Because it's all about, hey, the onus is on you. You are responsible for keeping these things consistent. The valuation for RMDs, all of those things are dependent on client, participation. Yeah. But if you don't have liquidity to pay the RMDs or liquidity to pay a tax bill on a Roth conversion, when it comes to RMDs, what I'm seeing is that they're actually journaling value from an IRA to a non-qualified account, and they're journaling it, but where the heck are you gonna get the tax money to pay the bill? Because you technically took an RMD by switching it from an IRA to individual, right? It's just a journal entry. But now, if you don't have the money to pay the tax bill,
where's the liquidity coming from?
Uncle Sam's going to come knocking, right?
Yeah.
And so I think the summary here in general is that the day of the real estate boom, who knows whether it's going to continue or not. The fear is that you lose all of the benefits of real estate, which include generally the depreciation benefits. So I would stay away. But if we're talking about self-directed IRAs, we're seeing tons of ads, mainly on conservative media, for gold IRAs. Hey, you've seen how well gold, because gold, right? Gold has performed. Out of the last 2.5 years, it's beaten the S&P 500.
Yeah.
So
now's
gold,
the time to get in, right?
Yeah, let's buy when the market's high.
Let's buy when it's high.
Yeah, listen, it's the fear of missing out, right? Sure. I mean, our company has been bombarded with SpaceX IPO conversations. People want in with what's hot. It's the fear of missing out, right? Is it the next Bitcoin?
Yeah.
But gold, is the rush going to continue, Nathan?
Can I just comment on the SpaceX and IPOs? Is that okay?
Yeah.
All right, sounds good. Because it's interesting that this fear of missing out of this pre-IPO, and you think that something's just going to go out and you're going to miss out if you don't get in. What's interesting about a lot of these pre-IPOs is you actually have less liquidity often when you invest pre-IPO because it's not a marketable security, meaning you're not buying it on the market. So when it does go public for everyone else to buy it, you usually can't sell it. They have certain restrictions for when you can sell your shares. So you see it go up and you're like, hey, I want to buy. I've had clients do that. They bought pre-IPO. They want to sell it once it goes up really quickly, but they can't because they bought it pre-IPO. Whereas if someone just bought it on the market, you can then sell it when it's on the market. So anyway.
Good point. I mean, I know that compliance has taken the position that as an advice idea, listen, who knows, and I know this show will re-air after the IPO as well, but, it just looks like exponential risk because, the goal of our company, the name of our company is asset preservation, right? We're not here to gamble with people's life savings. But gold, let's stick to the gold concept here. What are your thoughts on gold inside an IRA?
I mean, I think having a portion of it might put people in a position where they're able to sleep better at night, thinking that this is consolidated into an account.
But physical gold?
Yeah, definitely. And that's just the thing too, is like, how much do you go and buy or go and get? And then, we've ran into situations, Stuart, where you've had clients too, but I had a client recently where the husband ended up running into dementia, unfortunately. The lady comes to us and they literally have $500,000 that's all in gold, because he was thinking gold is going to go through the roof, and it has. But then when we go back to those brokers, there's a process that you have to walk through to actually get the gold sold. And, gold is at spot, and there's commissions that are being charged.
So spot is the price of gold.
100%. And, not only did you go and purchase it at a certain dollar amount, but you also have to go and sell it. And when you go and sell it, there's going to be a charge, that's happening on that too.
And so just to clarify, I think what Dan's talking about is that you're not dealing with fiduciaries when you buy gold. You're dealing with salespeople, right? Yeah. It kind of reminds me, and listen, with all due respect to the people selling gold and selling other things, they're commissioned salespeople. We have, it's the price that they tell you it is, right? So generally, we see 10 to 15% above spot when you buy it, 10 to 15% below spot, when you sell it, right? So how are you going to make up for 10 to 30% in fees?
Yeah.
Gold didn't move that much to justify a 30% fee, right?
Right.
So,
and then which gold coins are you purchasing, the polar
get out of here.
bear and all that, right?
To me, it's a fear sale. We had a client that wanted to go to cash not too long ago, because the U.S. dollar is going to completely collapse because of the BRICS nation. Listen, if the U.S. dollar collapses, we have way bigger problems than this here, right? Yeah. What are you going to do with your physical gold when the U.S. dollar collapses? Are you going to take it to the grocery store, or are you going to bite off a piece of it and give it to the cashier? Listen, I understand the nature of it. And we do use gold inside of our portfolios, right? But more inside ETFs as a hedge against inflation. But that fear sale of the dollar collapsing, and I just think it's an unfounded fear, Nathan.
Yeah, it's fear and greed. We've talked about this before a lot. Fear and greed are what drives a lot of the emotional components to our money and how we make decisions. So anytime we're using that, people are going to play to that. So, yeah.
Yeah, so I would just say this. When it comes to these kind of third-party, self-directed things, and then you have RMDs again.
Yeah.
Remember, gold doesn't provide a dividend. It doesn't pay any payouts
Where's
out.
the cash flow?
So you're going to end up having to sell it, and when you sell it for your RMDs, there goes the commissions again. Yeah. I remember I had a client in Northern California, kind of Central California. She was like 2 hours east of Modesto, out in the middle of nowhere, and her husband kept buying physical silver. And it would show up in auto parts boxes because they wanted to pretend it was just heavy car parts, so no one would steal it. Well, when he died, she's like, Stuart, I need money. I need to go. Well, I wasn't going to go fly there, drive 2 hours to take her to a pawn shop or wherever the heck she was going to sell her gold, because what are you going to do? How do you liquidate all of this gold? She had boxes and boxes of gold. The kids, when you're gone, generally don't know what to do with it. Yeah. And so they get hammered on the fee when you're gone. And I think that generally it's a big mistake.
Yeah.
And RMDs become quite an issue for those people as well. So let's spend the last few minutes here talking about taxes here again. Look, it's in the name of our company, right? Asset Preservation, Wealth, and Tax. I think taxes are some of the most underutilized kind of planning we see here, right? People realize that, that taxes matter. We are in one of the most efficient tax windows in history. How important is tax planning to you, Nathan?
It's like you have this puzzle and you're missing, if you're not talking about the taxes, then you're just missing pieces of the puzzle. And so what's the complete picture look like if you're missing these pieces? So it's huge. Going back to when I first started in this industry, before I got into finance, I started out in Washington, D.C. with the Committee on Ways and Means, which deals with taxes. And so from the very start, I saw how important, of course, how powerful Congress is too, by holding that over our heads too, with saying, hey, taxes, we're gonna always change. It's written in pencil, we're gonna change it. And we're at the mercy of what's going on. So we have to have a plan and then know, hey, it's going to change and we got to go back to the drawing board.
Well, you say it's going to change, and with the one big beautiful bill, I think we are in one of the most efficient tax windows in modern American history right now, and people are going to look back at this time and say, I wish I would have planned back when taxes were on sale. So when it comes to this sale that's going on, and that's what my wife says, right? Yeah. When it comes to purses and shoes, right? Hey, it's on sale. I'm gonna save money right now, so I gotta go buy it right now while they're on sale. But we know taxes are at all-time lows, right? Dan, what kind of tools do people have that can use these historically low tax rates?
Well, when you
right
keep
now?
saying we're in the most efficient tax season, I think it's important for everybody, our viewers at home, to understand what we're referring to is so many married couples right now are typically in that 22% bracket, especially during your working years. And so during that period, what we're referring to is you're talking 2% to jump from the 22% into the 24%. And the reason that's so efficient is that if we have a large 401k, IRA distributions that we need to pull from, that dollar amount's added dollar for dollar to income to our overall plan. And so when we do that, it causes us to be in whatever bracket we're in. When we jump from a 22 to a 24, it's only a 2% jump, right? Yeah. And so it puts us in a position where now we can have a much, much better position overall as we're pulling money, and puts us in a more tax efficient
there's
scenario.
A couple $100,000 of room in the 24% bracket that you can use for things like Roth conversion, or, listen, it's one of those things too. Does it really make sense to defer taxes right now? Like with the one big beautiful bill, and let's talk about the senior bonus deduction.
Oh yeah.
Right? Yeah. We saw clients that came in, new clients that came in, we did their taxes for the first time this year. And what I was seeing is that there were people that paid zero taxes, but didn't even use their standard deduction.
Big mistake.
It's up to almost $48,000, including the senior bonus deduction. So there's free money that you can take out of your IRA. Look, if you're in a position where you're not taking advantage of the current tax plan that's going on while taxes are on sale, if you're concerned about real estate like we talked about, being inside your 401k or your IRA, if you're talking about considering buying gold for your IRA and you want to get a second opinion, we're here to give it to you. But you have to ask for help. We have convenient locations all over the city here. Gilbert, Goodyear, Peoria, Scottsdale, here in Tempe. This is where we film our shows, in our Tempe office. If you want to come see us, we'd be glad to give you that absolutely free second opinion, but you have to ask for help. All you have to do is pick up the phone, call 1-833-602-PLAN. Once again, 833-602-PLAN, or even easier, if you click on that QR code at the bottom of your screen, that'll take you to assetpreservation.com, where you can claim your absolutely free review. Anyways, touch base today, take action. It's been great talking to you today. Can't wait to see you till next week. Take care.